There is a product you have never seen advertised on a billboard. It has no packaging, no factory, no shelf space. It doesn't require a single raw material, doesn't employ a single engineer, and never runs out of stock. And yet, right now, as you watch this, it is generating more profit than oil, more revenue than every technology company on Earth combined, more wealth than any empire in recorded history ever extracted from conquered territory. You don't just buy this product, you live inside it. It is debt. And if you think you understand what debt is, a loan, a mortgage, a credit card balance, then you have only seen the surface of something that runs so deep it shapes the very structure of who gets to be rich and who doesn't. Debt is not a financial instrument. It is the most sophisticated control system ever built. And the story of how it was engineered, who built it, and why it will never stop expanding is the story that the people who profit from it most desperately do not want told. So let's tell it. Here's the question nobody asks. If debt is just borrowing, just moving money from one pocket to another, then how has it made so few people so extraordinarily rich for so many centuries without ever running out? The answer is interest, but not interest the way you were taught to think about it. Not a simple fee. Interest is something far more radical. It is the discovery that time itself can be owned, that the future can be harvested before it arrives, that a promise, a simple human promise, can be turned into a perpetual revenue stream that compounds, multiplies, and never under any circumstances needs to end. That realization changed everything, and the people who understood it first spent the next several thousand years making sure that everyone else stayed dependent on it. Go back to ancient Mesopotamia. 5,000 years ago, the first debt records in human history were scratched into clay tablets, not by banks, not by governments, but by temples, sacred institutions, the very places where ordinary people placed their trust in something larger than themselves. And those temples lent grain at interest. They lent silver at interest. And when debts grew too large, when they threatened to consume the entire social fabric, leaders periodically wiped the slate clean. Debt jubilees, cancellations, resets. Because even then, the people in power understood something quietly forgotten in the modern world. When too much debt concentrates in too few hands, the society beneath it breaks. So what changed? Why did we go from a world that periodically canceled debt to a world that celebrates it, expands it, worships it as the engine of prosperity? The answer is a slow, deliberate, centuries-long transformation, a process by which the most powerful people in every era figured out how to make debt permanent, how to make the Jubilee disappear, how to turn a dangerous, destabilizing force into the foundation of their own unassailable wealth. In medieval Europe, the Catholic Church banned usury. Charging interest was a sin, which sounds like progress until you realize what actually happened. Bankers didn't stop charging interest. They hid it. They disguised loans as trade partnerships. They invented instruments that looked like contracts but functioned like loans. The ban on usury didn't kill lending. It taught lenders how to be invisible. And invisibility, as any power structure knows, is more durable than any fortress. By the Renaissance, the Medici family of Florence had turned this invisibility into an empire. Not an empire of land, not an empire of armies, an empire of credit. They lent to popes, they lent to kings, and in return they received something worth more than gold: leverage, the ability to make powerful men dependent. The Medicis didn't conquer the world, they financed the people who did, and they collected interest on every conquest. This is the moment when debt stopped being a financial tool and became a political one. The 17th century delivered the breakthrough that defined the modern world. The Dutch Republic, fighting for survival against Spain, issued bonds to their own citizens and used the money to fund a war. Then they made those bonds tradable. Suddenly, a government's promise wasn't just a promise. It was a commodity, an asset, something with a market, a price, a daily value. The Dutch didn't just win their war, they invented the architecture of modern finance. England was watching. In 1694, England created the Bank of England, and with it something that had never existed before: permanent national debt. Not debt raised for an emergency, not debt that would ever be paid off. Debt as a feature, debt as a permanent institution. The government would borrow, the bank would issue notes backed by that debt, taxes would service the interest, and the whole system would roll forward indefinitely, not toward repayment but toward perpetuation. For the first time, governments didn't just have armies, they had creditors, and creditors, it turned out, were far more reliable than armies for keeping governments in line. The bond markets that grew from this arrangement became the most powerful institutions in the world. By the 18th and 19th centuries, the great houses of European finance were determining which wars could be fought, which empires could expand, which nations would survive. Armies marched on borrowed money, navies sailed on credit, colonies were seized and stripped to pay interest to creditors who never left their offices in London or Paris. And while this great game reshaped the world's map, something quieter was happening in the lives of ordinary people. Industrial capitalism needed workers. Workers needed housing. Housing required mortgages. And slowly, steadily, the architecture of debt designed for kings and empires began its descent into the fabric of everyday life. By the 20th century, it had arrived at your front door. The mortgage, the car loan, the installment plan, and then in the 1950s, the invention that completed the transformation, the credit card, a small piece of plastic that told you every single day that you didn't have to wait, that you deserved it now, that buy now, pay later wasn't debt, it was freedom. This is the genius of it. Ancient debt was obvious. It was a burden, a shame. Modern debt was rebranded as aspiration, as the American dream. You didn't take on debt, you built equity. You didn't pay interest, you invested in your future. The language changed completely, and behind that language the machine ran perfectly. Because here is what no advertisement ever mentions. Interest doesn't generate profit once. It generates profit every single month indefinitely. A $300,000 house financed over 30 years costs $600,000 by the time the last payment clears. A credit card balance rolled over for a decade costs multiples of the original purchase. The debt transfers money from debtor to creditor month after month in a stream designed structurally, mathematically, deliberately on never to end. Banks don't want your debt to end. They want it to roll. They want it to refinance. A debt repaid is a revenue stream terminated. A debt extended is a revenue stream that compounds. This is what the system was built for. Not to help you buy a house, to generate compounding interest on perpetually outstanding balances. And the longer you stay in debt, the more precisely you are functioning as the system intends. By the mid-20th century, this system went global. The IMF and World Bank were presented to the world as engines of development, as helpers of nations in need. And they did help, but under conditions. Loans came attached to requirements. Cut this, privatize that, open your markets, remove your protections. Structural adjustment, it was called, a neutral, technical phrase. What it meant in practice, a country could borrow, but only by surrendering the right to make its own decisions. Debt became a mechanism of control more durable than any colonial army. Colonies required troops to maintain. Debt required only a signature. The 1980s made this brutally visible. Western banks flush with petrodollars had lent heavily to developing nations. Then the United States raised interest rates. Countries that had borrowed in dollars found their obligations doubling in local currency terms. Mexico declared it could not pay in 1982. A cascade of crises followed. The solution from the IMF was more loans under harsher conditions which required more borrowing, which demanded more austerity. Ordinary citizens paid with their children's futures. Creditors collected interest. Then came the final evolution. Wall Street discovered that debt itself could be repackaged and sold, mortgages bundled into bonds, car loans packaged and traded globally. The financial system became less an engine of investment and more a machine for transforming debt into product, extracted from its human context, stripped of its meaning, traded by institutions that had never met the borrowers and never would. When that machine broke in 2008, when mortgage-backed securities built on the premise that American homeowners could never fail en masse turned out to be fiction, The system revealed exactly who it was designed to serve. Ordinary families lost homes, savings, and jobs. Banks received government bailouts. Not one senior banker went to prison. And when the emergency passed, the prescription was more debt. Lower interest rates, trillions in new money funneled primarily to the institutions that had caused the crisis. Global debt today exceeds $300 trillion, more than 3 times the entire annual economic output of every nation on Earth. And this mountain of obligation is not described as a crisis, it is described as normal, as growth. This is where we live, inside a system that has spent centuries perfecting the art of making its own perpetuation feel like your prosperity. Every time you carry a credit card balance, you are a node in a network that runs from the clay tablets of ancient Mesopotamia to the trading floors of modern Wall Street. Every mortgage payment, every student loan installment, every month you don't quite pay off what you owe, you are functioning exactly as designed. The most powerful trick debt ever pulled was convincing the world that it was a tool of the borrower. That credit is freedom. That leverage is opportunity. But the history of debt tells a different story. Debt is always ultimately a tool of the creditor, designed by the powerful, refined by the powerful, protected by governments that the powerful fund, and it flows and always, inevitably, an upward. Interest payments are not just financial transactions. They are the most consistent, most durable wealth transfer mechanism in human history. From the many to the few, from the future to the present, from the debtor who agreed to a promise to the creditor who is counting on that promise to last forever. There is a reason debt jubilees disappeared. There is a reason the language around debt shifted from shame to aspiration. It is because debt, structured correctly, is not a problem to be solved. It is a product to be sold. Endlessly, renewably, profitably, and the people who sell it have spent centuries ensuring that the people who buy it never quite understand what they're actually purchasing. The clay tablets have been replaced by digital ledgers. The parchment bonds of the Dutch Republic have been replaced by algorithmic trading systems. But the structure is unchanged. The promise, the interest, the compounding, the permanent design to be permanent obligation, and the quiet, expertly managed transfer of wealth from those who owe to those who are owed. You are living inside the most profitable product in human history. The question is whether, now that you see it, you can begin to understand what it truly costs. History has the answers. Subscribe. I'll show you where to look.